Welcome back. This morning, the PCE personal consumption expenditure was reported on a month-over-month basis. The PCE rose 0.4%. This is the biggest increase this year, only surpassed by the increase we saw in January. On a month-over-month basis, 0.4%. The red histogram bar shows us core PCE, which excludes food and energy, and it's declining. So inflation is declining, taking out fuel and food and fuel. But with food and fuel, especially energy, inflation is rising. Green, 0.4%. That's on a month over month basis. That's a PCE versus 0.1%, not taking into consideration energy and food. On a year over year basis, 3.5% for PCE, core PCE up 3.9%. Here's in yellow personal consumption expenditure on a year over year basis. The red line is crude oil, a very strong correlation indeed. Fuel energy is a very large component of the inflation number, and we can see when energy rises, so does inflation. When energy falls, so does inflation. A very strong match between these two. Now we see here the black histogram bars represent the federal funds rate. We had a period of time, 2020, 2021, with very low interest rates. That created the inflation. The Federal Reserve is now painted themselves into a corner in the sense that we have very high interest rates, the most fastest rapid acceleration of interest rates in a very long time. And inflation has come down, but now it's turning back to the upside. And the Federal Reserve has not met their 2% targets. Here in blue, PCE year over year versus the S&P 500 in red. And we can see now the stock market has been weak. This stock market quote updates to, or it's matched with the PCE data, which is as of last month. However, we can see a very strong correlation. Notice we have a little bit of a delayed effect as we see the PCE reach a significant low. The stock market hit a significant low that period of time. But notice October of 21, that's when the S&P 500 hit a high. Few months later, inflation hit a high. The stock market then hit a very significant low in October of last year, and then inflation hit a low maybe the past few months. Now we see both have turned around to the upside. Now, what is the difference between CPI and PCE? They both measure inflation. CPI is the consumer price index, PCE is personal consumption expenditure. There are several nuances, but I found this very interesting. The CPI derives its inflation data from household surveys. The PCE uses data from the GDP reports and from suppliers, mostly from GDP. So it really is a difference. When they calculate CPI, they ask all of us, how are you doing? How's the inflation treating you? PCE, it takes it from the GDP report. The reason we mention this is because take a look at the difference between the two. Again, CPI in yellow, year over year basis, that data is derived from the household surveys. PCE is derived from GDP. When we hit those very significant highs early 2022, the CPI was much higher than the GDP. Now, this shows us that the data they received from household surveys was much higher than the data they received from the GDP. Does that mean something? Now that we hit very significant lows, it seems to have returned to a very somewhat very matched equal correlation. When they both hit very significant lows around the same period of time on the same level, now both around 3.5%. Well, what do you think about that? The fact that the CPI, again, which is derived from household surveys, indicated a much higher rate of inflation than the inflation that was recorded derived from GDP. Of course, GDP is only reported quarterly. Maybe that has something to do with it. The black histogram bars in the background, by the way, that shows a CPI divided by PCE. The fact that it's near or at record highs shows us that CPI is still much higher than PCE. The household surveys are telling a much more inflationary story than the GDP report is. Again, so PCE on a month-over-month basis, the biggest increase we've seen since January, largely fueled by energy prices and fuel prices. And we have a Federal Reserve target of 2%. And the Federal Reserve has, in fact, very recently reiterated their 2% goal. They do not want to stop raising interest rates, or at least they do not want to cut interest rates until inflation is at 2%. Well, the Federal Reserve likes to focus on the core PCE, which is still up in the 3% area. The PCE, including food and fuel, is turning back to the upside. So, based on this chart and Federal Reserve commentary, it doesn't look like they're going to stop raising interest rates, or at least they're not going to cut interest rates for the foreseeable future. We hope this has been helpful. We look forward to seeing you back soon.